The parade of economic and GDP downgrades has begun, and it's just getting started. From the Atlanta Fed to a rash of Wall Street banks, the rush is on to downgrade economic expectations. And given that, you have to think as the Federal Reserve meets today that it is feeling trapped. After all, we've got central banks around the rest of the world that are rapidly decreasing their rates, which means the Fed has to be feeling the heat. We're starting to see people like Mohammed El-Erian, who's one of the most establishment thinkers there is, think that the Fed needs to begin leaning toward the rest of the world, which is well underway toward this race to the bottom, where El-Erian is increasingly worried that really is the underlying case for the real economy. He's been joined by a number of banks and brokers all beginning to worry the economic trajectory is indeed at high risk. Even after the complete mess over the first quarter for GDPNow, which is the Atlanta Fed's GDP tracker, it's still basically zero growth from the fourth quarter, meaning that it's picking up big-time weakness on the tracker, even if the tracker has trouble keeping track of gold flows. And we'll cover what that means here today. And speaking of gold, it continues to hit record highs as this, quote, uncertainty is unrelenting. Only it isn't uncertainty. On the contrary, it's becoming more, not less certain. Gold is rising because of those fundamentals. And those fundamentals are not inflation. We know that from what just happened in Canada with its CPI and bond markets, a preview of what we should expect from the tariffs. Remember, central bank policies aren't stimulus or aid. They're a reflection of economic circumstances and how central bankers perceive them. Lowering rates simply means getting out of the way of the market by agreeing with the market in the way that it has been pricing those fundamentals. The Fed is not going to say anything today. Officials there are waiting for confirmation from macroeconomic data. They're going to continue to talk about uncertainty even as things become more and more certain, including the fact that central banks around the rest of the world have cut rates a lot more than people appreciate, gone a lot farther. They're well into this race to the bottom. And so the next step getting the Fed to join the rest of the world's central banks is to have people around the Fed, such as Wall Street economists, begin talking in the same way as we see at central banks around the rest of the world. That is, to downgrade economic growth expectations and begin talking more confidently and forcefully about the prospects for weaker economic growth, and even maybe the dreaded R word. And that's exactly what we're getting. As we've seen just recently, we've got downgrades from Wall Street banks up and down the street, starting with Morgan Stanley. The bank's U.S. economists, led by Michael Gapin, on Friday lowered their 2025 GDP growth call to 1.5% from 1.9%, which is measured on a fourth quarter versus fourth quarter basis. So they're talking about the entire full year GDP down to 1.5%, which is consistent with a lot of significant weakness in the first part of this year. And there's more. Quote, while our baseline outlook is that the economy avoids a recession, we acknowledge that the accelerated policy implementation and front-loaded policy uncertainty push recession risk higher. They're blaming this on tariffs when it's really the fundamentals that we have before we even got to 2025. We think that the trigger for a downturn would most likely come from a downdraft in equity markets, which is not how the economy works. Instead, as I keep pointing out, the equity markets pick up on these signals where the recession conditions are developing, and so the equity markets go down. That doesn't create the recession, it's a reflection of it. But from the perspective of economists, what's the difference to them? Goldman Sachs, larger tariffs are, quote, likely to hit GDP harder through their tax-like effect on disposable income and consumer spending and their effect on financial conditions and uncertainty for businesses. The bank took its 2025 forecast down to 1.7% from 2.2%, again, fourth quarter on fourth quarter, seeing significant weakness. And again, they're blaming tariffs, but at least looking at them in the right way. As prices for tariffs go up, or prices go up because of tariffs, that's going to destroy demand. It makes it harder for consumers and businesses, too, to spend on other things. You're taking money from one place in order to give it to another in most unproductive fashion. So as we see in the non-economic oil price spikes over the last couple of years, the end result is not more inflation, it's more economic weakness. At least Goldman Sachs gets that part right. And so we have raised our 12-month recession probability slightly from 15 to 20%. That's only a limited amount of change for now because the White House still has the option to pull back if the downside risks begin to look more serious. However, if the administration remains committed, even in the face of much worse data, the recession risk would rise even further. They're looking at tariffs as the ultimate shock or the proximate shock to cause a recession. That's how economists believe recessions develop. Traditional style recessions, you have an economy that's operating, whether it's under or near capacity, then a shock happens, which sends it off into a full-blown contraction. So that's what the economists are looking for. And what they're really saying here is that given tariffs and really the uncertainty around the rest of the economy, they're seeing higher and higher chances of a traditional style recession. And these are economists who talk the same language and think the same way as those at the Federal Reserve. So as these economists are speaking publicly about what they're seeing in their econometric models, it's the same econometric models that the FOMC is looking at right now as we speak. The most pessimistic of them has to be the Atlanta Fed's GDPNow GDP tracker. Now, that had been around 2.3% growth, the initial estimates from the GDP tracker, actually a little bit higher. So 2.3% around the end of February, they're thinking for first quarter GDP, after the fourth quarter was in the same range. On February 28th, the Census Bureau published estimates on advanced trade, including things like imports, which imports, as we saw, soared, absolutely skyrocketed. And as a result, because imports are a subtraction from GDP, the GDPNow tracker went from plus 2.3% all the way down to minus 1.5%. And then on March 3rd, the GDP tracker was dropped even further to minus 2.8% with the advanced indicators on personal spending and personal income, which I've noted before. The personal income numbers were incredibly weak, and the spending figures weren't all that much better. There was a massive $20 billion or so inflow of gold, mainly from Switzerland and some from the UK, which was gold trying to beat tariffs. With the fear that import duties will be placed on gold, gold dealers were importing gold from all over the world, everywhere they can get their hands on it, and that, of course, showed up in the Census Bureau estimates. However, the Bureau of Economic Analysis, the government agency responsible for putting together the GDP figures, does not count imports of non-monetary gold in its GDP estimates. So for the GDP tracker to get back on track, the Atlanta Fed is going to have to jigger with its current models and its current assumptions. And they're in the process of doing that, which supposedly they're going to update their GDP tracker models in the next week or so. But already there's been a preliminary assessment when they take out gold that got GDP back to minus 0.4% as far as that last data that was released. But still, minus 0.4%, that's negative. And then they raised the estimates a little bit further after the payroll numbers came in, because the GDP tracker takes some of the data from the establishment survey and uses that to approximate what GDP components will look like. And so they got the GDP number for the first quarter back up to 0.4%. So it's on the plus side at least, but 0.4% is substantial weakness. And this focus on gold imports obscures the fact that we have weak spending, weak incomes, weak retail sales, falling consumer confidence, all the things that you would associate with a plus 0.4% GDP quarter or a minus 0.4% GDP quarter, substantial weakness in the real economy that can't just be ignored as a product of gold imports. So that's what Wall Street's economists are doing, similar to what GDPNow is doing, trying to come to grips with what's happening in the first quarter, the start of this year, which is, for them, unexpected, which is why they keep using the term uncertainty. They were certain we were going to hit a soft landing. Now they're seeing the evidence suggest maybe not. And because there's rising risks of weaker economic outcomes, they're looking for a reason for it. It can't be their interpretation of the economy, the soft landing economy before. It has to be tariffs and trade restrictions. So at the Fed meeting today, and by the way, I'm recording this before the announcement comes out because I don't really think it matters all that much. What they're going to say is very likely the same thing they said last time, which is we don't really know where the economy is going. We're worried about economic weakness, though they won't say that. But we're also concerned about consumer prices because consumer price numbers have been stronger than expected recently. And their theory of inflation includes tariff impacts on consumer price numbers. So basically, they're paralyzed. They're going to play it cool in public, say strong and resilient over and over again, but also acknowledge that they'll say there are risks on both sides. There's risks to the downside in the economy, but there's also risks to the upside in terms not of the economy, but of consumer prices. You got to keep in mind how these economists think inflation works, which is not how inflation actually works. Their view of inflation rests on expectations theory. They think if you and I believe inflation is happening because we see it in higher consumer price numbers like the CPI, then that will change our behavior as if inflation is happening, and then the change in our behavior becomes that inflation. So the Fed thinks that it has to counter that expectation by giving you and me something else to think about, which is the idea of restrictive interest rates. And so if they're worried about inflation expectations unanchoring, becoming out of control, then they're going to give you the idea that interest rates, their policy rates, are restrictive. Therefore, that will depress your instinct to do something about these consumer price worries that you and I supposedly have. And it's all complete and utter nonsense, which is why eventually the Federal Reserve is going to see reality, and that reality is going to force them to act in the same way that we see other central banks acting already. Because ultimately that's the thing, as Wall Street banks are picking up on, as the Atlanta Fed GDPNow estimates picking up on, things have shifted in the wrong direction here in the first quarter, and they're not looking like they're going to get better as we move on further into 2025. Again, that's what other central banks around the world are reflecting with their policies. They see the same types of things, and it's only a matter of time before the Fed is shifted in that direction as well. But this is a key step in moving in that direction. The economists that talk and think like the Fed are already talking and thinking like other central banks are already acting. And the global aspects of all of this is something we're going to talk about on Monday, March 24th at noon. There's a link in the description to sign up for Eurodollar University's webinar. What are the latest global trends that we're seeing, including the central bank race to the bottom that's well underway and much further along than most people appreciate? Not to mention how a possible traditional recession developing in the US might affect everyone else around the rest of the world and what you might be able to do about it. That's our webinar next Monday, March 24th at noon. There's a link in the description to sign up. I do hope to see you there. We've seen a moderate example of this in Canada just this week, in fact, just yesterday. The Canadians reported a red hot CPI for the month of February. It was the biggest monthly jump in the index since May of 2022. So almost 3 years going back to the supply shock, the height of the supply shock. It was the highest core year-over-year rate since August of 2023. The reason for the increase in consumer prices was the Canadian government ended the tax break on GST and HST taxes in the middle of last month. And while everyone knew the tax breaks were going to expire, the consumer price estimates came in well above expectations anyway. It's going to continue into next month as the full effect of reinstituting the taxes will be felt. So you would think, given how the mainstream constructs its narrative about inflation as well as central bank policy reactions to it, that this sky-high CPI report for February in Canada, along with the likely next one in March, that's got to get the Bank of Canada to rethink its rate cutting plans, right? That's got to at least put them on hold. It puts them more into a hawkish frame of mind, given how central banks conceive of this and how we're supposed to think about how these things like tariffs or increases in taxes play into higher consumer prices and therefore feed into inflation. But that's certainly not how the market reacted to it. Instead, the downward trend in market interest rates, Canadian bond rates, it's still going. There's a little bit of a fluctuation at this moment, but hardly any reaction to the CPI report at all. If there's any expectation that the Bank of Canada is going to alter its rate cutting policy, it's not in the Canadian government bond market at the moment. Because the bond market knows, as central banks are worried, and they know this too, they just have this flawed inflation theory, that higher taxes, like higher tariffs, are going to end up being worse for the economy, not inflationary. That means more demand destruction combined with other increasingly negative factors, even before you get to the tariffs, which means eventually central banks are going to see that weakness and respond to it by further lowering rates. The higher taxes go or the higher tariffs go in the short run, the more weakness there will be over the intermediate and longer term, which means rates are going to go down over the intermediate and longer term, though many of these places like Canada, rates are already going lower right now today. Even Mohammed El-Erian said as much in his latest TV appearance. Here's how Bloomberg wrote it up. The Federal Reserve needs to make it clear that at its policy meeting today that it may have to cut rates if there are continuing signs that the economy is slowing. But the central bank should communicate all of this in a way that convinces people that you will have the possibility of rate cuts, not because inflation is coming down, the so-called good news cuts, but because growth is problematic. Bad news cuts, he said. So that would put the Fed right back on course to where all these other central banks already are. If the economy deteriorates even more, then ultra low rates are going to happen. There's no surprise there. What is a surprise is that the chances of this happening are rising, and they're already higher than more people really appreciate. That's what markets are saying, not just the ones in Canada either. That's the same thing that we're getting in the gold market too, with gold hitting an all-time high yesterday, being above $3,000 per ounce for the first time on Monday. And the gold market, that's not an inflation signal. I mean, gold lagged in 21 and 22 when consumer price rates were at their absolute highest. And then gold started to pick up late in 2022 as the global economy started to forget how to grow. So gold soaring recently is another one on this worsening economic outlook, both here in the United States as well as abroad. In fact, it's gone up so much, it's almost keeping pace with copper's surge this year, which means the copper to gold ratio hasn't actually moved that much off of its recent lows. Even though copper is up 25% on a supply squeeze and panic buying in China, copper to gold is marginally higher than its lows because gold is keeping up on the other side of it. And contrast that to last year's copper supply squeeze when the copper to gold ratio was sent much higher, if for other reasons than the copper to gold ratio normally shows. So gold is saying, and gold keeping up with copper in a non-economic supply squeeze is saying, those who are buying gold are afraid that the economic conditions and the financial conditions this year are materially worse than was perceived to be just last year too. So you have more and more markets that are preparing for worsening conditions, and I don't mean worsening conditions in the forgot how to grow sense of the term either. More of the traditional style recession probabilities. We've got gold, we've got stocks, especially small caps. I talked about credit spreads yesterday. Bond markets, not just in Canada. While the Fed is stuck on its inflation theory of tariffs and past prices, the rest of the world is seeing the economic risks more clearly, and they're not aligning in the direction of inflation. So the chances that the Fed is going to be able to hold out while all the rest of the central banks around the world continue to race headlong toward the bottom, they diminish with each of these Wall Street downgrades, with each of these market signals. Uncertainty isn't rising. In fact, uncertainty is falling with all of the other economic and market downgrades. That's why the retail sales report was such a big one, because of what it said about the consumer angle and all of the soft landing uncertainty stuff. And I went over the details in the video link below. As always, thank you very much for joining me. I hope you can join me next Monday for our webinar. There's a link in the description. Huge thank you to Eurodollar University members and subscribers. And until next time, take care.